If you're looking for opportunities in the large cap pharmaceutical space, well, there's one company which could be interesting because of its product pipeline. In our ideas for profit today, I will discuss about Dr. Reddy's Q4 earnings as well as the strategy investors should adopt on this one. Well, Q4 FY20 sales for Dr. Reddy's increased by 10%, mainly led by performance of the developed markets, namely North America as well as Europe. Now, the sales of North American business was actually driven by new product launches, higher volumes, as well as the coronavirus related stocking up of medicines. Now, during the quarter, company launched 5 new products as well. Domestic business, on the other hand, grew by 5% and was partially impacted due to the logistics-related disruptions caused by the coronavirus-led lockdown in the country as well. Now, revenues from Europe grew by stupendous 49% on a year-on-year basis, primarily on account of volume traction in Germany and new product launches across markets, including newer markets of France, Italy, and also Spain. Gross margins fell 90 basis points due to unfavorable regional mix and also price erosion that was seen for USA and European businesses. Now, sequential decline in margins of 260 basis points was also on account of increased provisioning for inventory. Consequently, EBITDA margins were also impacted, partially offset by the lower operating expenses. Now, if we look at few launches by the company in the USA in the last 3 months alone, they all cater to niche applications and some of them requiring a differentiated drug delivery vehicle as well. Now, cumulative market size of these drugs is about $200 million. As far as US market pricing headwinds are concerned, the management sounded that this scenario is quite stabilizing now. Having said that, the normalized single-digit % pricing erosion is still expected to continue due to both strong negotiations by the wholesalers and also natural competition on account of the new approvals for the generics as well. Now, recently, Dr. Reddy's also received few positive inspection reports from US FDA for its formulations plant located at Srikakulam. FDA closed the inspection with no observations. For its API manufacturing plant at the same location, status received is voluntary action initiated. Now, management considers this as a successful resolution because this unit had been a key overhang for the company. It was earlier issued a warning letter in November 2015 as well. Now, other than this, recently company also received US FDA approval for the drug celecoxib, which is indicated of the acute treatment in migraine in adults. Now, as of 31st March 2020, the company's 99 generic filings are pending for approval. This includes 97 ANDAs or abbreviated new drug application and 2 NDAs, new drug applications. Now, in the current fiscal, company expects R&D expense to really remain in the vicinity of 9-10%, where in biologics and injectables are likely to remain key focus. Potential impairment of inorganic opportunity or maybe sharp price erosion for the new launches in the USA market also remains a key risk for the company going ahead. Case in point, NuvaRing or hormonal contraceptive. Now, this market is where the opportunity size has really shrunk. Now, while management has avoided to commit to FY21 sales guidance due to the uncertain business environment caused by COVID-19, commentary on few of the critical drivers of the business exudes confidence from the company side. Now, this includes product launch pipeline of 25 for FY21. On the margin side, the company remains confident of maintaining the gross margin range of 52 to 54% and aspire to reach a 25% EBITDA margin in the foreseeable future as well. Now, management sees a substantial scope in the improving of the operating metrics, both based on productivity as well as on the operating leverage as the company really expands to newer markets. Now, despite the recent strong rally, the stock is still 8% lower than the 2015 highs that was seen and trades at 13.5 times FY22 estimated EV to EBITDA. Now, while the valuation is relatively expensive, zero debt balance sheet is comforting in spite of the steady capex commitments that the company has for the future. Now, we do see that the company is among the few with the potential to really meet the challenges in the complex pharma opportunities which may get created in future, and hence accumulation of this opportunity is advisable for investors only with higher appetite or higher risk appetite in our opinion.